Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, this will be the last show that I'm going to do before the US election in 2 weeks. Now, the election's on the 3rd of November, and of course, that's going to be one of the biggest market moving events in the next few months. So what we're going to do is do a show now, and then we're going to pick up with the reaction that market has to whatever the outcome is in that particular election after the election's taken place. So for now, we're going to look at what's been going on in the last week or so. And if you recall from last week, we had technology stocks taking off. The uptrend that had started from the rebound from the September low after the sell-off in technology stocks is still in place, and we're still seeing that, although we've had little bouts of weakness in the last couple of days. And the real narrative of this week is almost a deal or no deal. And when I say deal or no deal, I'm talking about the potential deal in terms of government stimulus in the US, but also the Brexit deal. So what sort of deal is being negotiated between the UK and the European Union? Now, the market is currently betting on both happening, because if we focus on the European point first of all, so if you recall, there was a mid-November deadline. It was a self-imposed deadline really by the UK government, and Boris Johnson then decided to throw his toys out the pram and say he wasn't going to be involved in the discussions anymore. Well, we've got to the point now where both sides are coming back to the negotiating table with a potential for a deal in mid-November. So the market has got really excited about that. So it started to price in the fact of a potential no deal, a bit of a wobble on the UK pound versus other currencies. But then they've now decided that there's a potential for a deal before the end of the year, and we've seen the pound strengthen. On the flip side, in America, as I've mentioned in the last couple of shows, we're starting to get almost a consensus of opinion that we're going to get a Biden win. We're going to get this stimulus from the US government, hopefully before the US election, but they are pricing in almost certainly after the US election. Then the dynamic and the movements in markets have been quite considerable. We get this whipsawing effect depending on whether people think they're going to be a deal or no deal in both of these scenarios. But the place where you really are seeing it at the moment is in currency markets. Now, if we focus on the dollar index, you may recall that I've talked about the dollar index quite a bit in the last couple of months. And if the dollar was weakening, there was a downtrend where the dollar started from about June, started to weaken quite aggressively. And that weak dollar started to push up, for example, the price of gold. We saw US equities inflate. We saw a weak dollar is obviously good for emerging market assets. It's actually pretty bad for the FTSE 100, because if the pound strengthens against the dollar, it tends to be negative for the FTSE 100. And the FTSE 100 had been lagging anyway, so that was another headwind for the FTSE 100. Well, in the last week or two, we started to see the dollar strengthen. So the dollar index was pushing up above 94, or people were saying, would it hit towards 96? And if it did breach that level, then we could see this downtrend unwind, and that would pull the rug from under markets. And a lot of the momentum trades we've been seeing across the summer, well, we hit a level. It was almost right up to the downtrend line that we'd been experiencing since the middle of June. And we had an aggressive pullback this week. And part of that reason for that pullback, so the dollar suddenly reversed course and started weakening again aggressively. Part of that was because of this idea that we might get the stimulus from the US government. But there were also some dovish comments from the US Federal Reserve. So the Federal Bank in America started to make noises about more stimulus, monetary stimulus, could be needed in the future to combat the downturn we've seen in the economy. So, of course, that's weak. Or will weaken the dollar versus most other currencies. That's what the dollar index measures. So as we saw the dollar index start to plummet, we saw gold leap to $1,930 per ounce. It was a positive. It supported US equities, and we saw emerging markets. They're actually one of the best performing assets in the last week in terms of equity assets, equity markets around the world. And that's because of that weak dollar. But when we saw the dollar tumble, there's always a sign that almost a bit of risk appetite. So we saw risk assets start to pick up, and we saw money move towards risk assets. We have seen about a weakness because we're getting this sort of flip-flopping, the changing of narratives, a bit of nervousness. The VIX, the fear index in the US, has picked up towards 29. When it gets above 30, that is a sign that we could see even more volatility and nervousness and potential downside for US equity markets. As we stand, the S&P 500 is around 3,435. So we've pulled back from those all-time highs and an attempt to hit those all-time highs we saw in September. But the market as it stands is trying to find a sense of direction. So while we've seen some buying in US equities and equity markets generally, we've seen the opposite in bond markets. So bond markets obviously tend to move in the opposite direction to equities. It's not a perfect relationship. It does vary over time. Sometimes you get them moving both in the same direction, which is a nightmare for a diversified portfolio when you're trying to balance risk and manage risk when you have equities and bonds. When they move in the same direction, that's not really what you want to see from a diversification perspective. But this week, we saw bond markets start to weaken. So we saw yields go up. Remember, if yields go up, then the value of the bonds start to fall. So we saw the US Treasury yield pop up towards 0.8. And we saw the similar pattern, the sudden rally in yields, which means that gilts were falling in the UK, where we saw the UK 10-year gilt yield push up towards the 0.275 level. Now, everybody's asking, is this the start of a bigger trend? Because obviously bonds, and what we're talking about here is the sort of longer term developed market government bonds. We're talking about UK gilts and US treasuries have been in a downtrend in terms of yields for quite some time. And people are wondering, is this a reversal of that trend? Are we about to see the bond markets collapse, which in some ways will be good news potentially for equity markets as people maybe move towards riskier assets? It's why they're collapsing, which is the key thing here. Because if you remember back in March, we had bond markets collapse at the same time as equities. That was just all out panic as people rushed towards cash. But one thing we have to remember, we've seen a lot of these trends tested. So these downtrends tested or uptrends tested in the last couple of months. And like the dollar index, it was pushing higher and it actually tested the downtrend we've had over a period of time. And once it hit that upper level, that resistance line, then if you imagine it was a sloping resistance line, once it pushed up towards that, it's now reversed and pulled back down again. Those trends could change, but the message really is that don't bet on this being a sustainable or more real dynamic long-term change. Wait to see what happens. Because actually in the lead up to this US election, what we're seeing in the sort of smart money, the professional money, is that they are really not placing any big bets on outcomes. They've learned from the US election back in 2016. So what they tend to do is nothing. And doing nothing is a decision in itself. So some people feel you have to make a bet which way the election could go and what the outcome could be, but that is obviously a very risky thing to do. So from a risk management perspective, perhaps not doing anything and diversifying your portfolio is always going to be the more preferable thing to do. Now, when I was talking about currencies, if we jump to the FTSE 100 and the pound, now the pound has rallied substantially against the dollar. So we burst up to that key $1.30 level on the pound dollar exchange rate. In fact, the pound leapt 1.79% in a single day this week, which is the biggest gain that we've seen since March. And part of that reason is the dollar weakness, but also because the idea or optimism we might get a deal of sorts between the UK and the European Union. And of course, if you are an investor with overseas holdings, so you've got US equity funds, for example, then you would have seen, even if US equities picked up, you would have seen your fund value in those particular asset classes tumble because of the currency exchange rate. So don't be surprised if you saw your global equity funds fall by 1 to 2% on a single day this week, despite markets not falling that much. And that will be the currency exchange rate. Now, it's a brave person who bets on currency markets because they can move very violently. And we are in the midst of this whole Brexit saga and expect more volatility in currency markets. So the impact of the currency market of the pound rally, and obviously, as I said, on global funds But even if you look at the FTSE 100, so if you had some UK all companies funds, then the FTSE 100 has been lagging. It's down 2.64% in the last week. It's down around 5,770, and that's because of that rally in the pound. It's bad for the FTSE 100 because, as I've explained before, with a lot of the constituents of the FTSE 100 making their earnings overseas and then maybe being earned in dollar terms, then that obviously can have a negative impact when it's repatriated to the UK. But as I said in the last week, if you look at the impact of the pound exchange rate, the weakening of the dollar and the strengthening of the pound, the S&P 500 is down 2.4%, and that's in pound terms. So it's not down as much if you just do it in the local currency, but in pound terms, when you factor in that currency exchange rate, then it's quite a significant fall. Now, as I said, the weak dollar's helped Asian equities, so they are down about 0.9% in the last week. Emerging markets are down around just 0.72%. So Asian equities, as I mentioned, I think in last week's show, remain a really good diversifier at the moment, and they're outperforming Western markets. And I'm talking about diversifier of your equity component of your portfolio. So there's still a lot going on in investment markets at the moment. Lots of ranges being tested, but we are actually almost range bound in a lot of ways. We're seeing markets, if you go back from now, back towards September into August, you can see that a lot of markets have rallied and fallen, pulled back. I'm talking about equity markets, currency markets, bond markets. And it's because there's a lot of these narratives out there, like the US election, like Brexit, like the coronavirus, that are still unfolding. There's a lot of uncertainty about what's going to happen. So perhaps doing nothing has been one of the best strategies, because those people who've tried to chase all of those different narratives and the headlines that have come out on each of those different topics, then they have sometimes been burnt by chasing their own tail. Now, ahead of the US election, we've still got earnings season. I mentioned earnings season in the US last week, and bank earnings came out, and they painted a picture of a cautious consumer. So that is something that we've got to bear in mind going forward. We're going to get more earnings in the coming weeks. Towards the end of the month, we're going to get those US tech earnings, which will be interesting. And of course, just days later, we've got the US election. So next time, it's going to be an interesting show. There's going to be a lot that's happened. There's probably going to be some knee-jerk reactions from market. But at this point in time, there's a lot still up in the air. And perhaps doing nothing is the best thing that we can do in the lead up to such a risk event. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me, Damien at moneytothemasses.com is the email address. I'm on Facebook. Find our group, the Money to the Masses community, at facebook.com/groups/Money to the Masses. Of course, Twitter, Money to the Masses is the Twitter handle. And of course, Instagram, and subscribe to our YouTube channel.